The markets are closed. The screens are dark. The ticker is frozen at $79.25. It is the holiday season. People are resting. But if you could look inside the boardrooms of Lower Manhattan right now, or the conference rooms of the Federal Reserve, you would see a very different scene. You would see panic. We are receiving indications that emergency risk management meetings are taking place this weekend across the highest levels of the global financial system. Why? Because silver rose 10% in a single day. Because a 10% move in a core commodity is not just a trading event, it is a solvency event. When an asset like silver moves that fast, it breaks things. It breaks the risk models of the banks. It breaks the margin requirements of the hedge funds. And most dangerously, it threatens the stability of the clearinghouse. The clearinghouse is the central spine of the market. It guarantees every trade. If a major bank cannot pay its debts on Monday morning because they are short silver, the clearinghouse has to pay. If the clearinghouse cannot pay, the system freezes. In this emergency broadcast, we are going to expose the reality of what is happening behind closed doors this weekend. We are going to analyze the emergency playbook that the banks use when they are cornered. We are going to look at the potential for rule changes on Monday morning, margin hikes, position limits, and trading halts. And I am going to explain why these meetings are not a sign of strength. They are a sign of total loss of control. The banks are meeting because they are terrified of the Sunday night open. They know that if silver gaps to $85, the game might be over. This is the story of the weekend the system blinked. To understand why these meetings are happening, you have to understand the math of leverage. The banks do not trade silver with their own cash. They trade with borrowed money. They use leverage of 20 to 1, sometimes 50 to 1. This works great when the market is quiet. It generates free money. But when the market moves 10% against you, leverage turns into a weapon of mass destruction. Let's do the math. If a bank is leveraged 20 to 1 and the price moves 5% against them, they lose 100% of their equity. They are wiped out. Silver moved 10% on Saturday. That means any entity that was leveraged 10 to 1 or higher on the short side is currently insolvent. Their equity is gone. They owe money they do not have. Usually the bank would just issue a margin call and force the client to pay. But what if the client is too big to fail? What if the client is a massive industrial hedger, or a sovereign wealth fund, or another bank? You cannot just liquidate them without crashing the entire market. So you hold a meeting. You call the regulators. You call the Fed. You say, we have a problem. If the market opens on Monday, Bank X is going to default. We need a solution. This is exactly what happened in 2008 with Bear Stearns. It is exactly what happened in 1998 with long-term capital management. And it is exactly what happened in 1980 with the Hunt brothers. They met on the weekend to change the rules so they wouldn't have to pay the bill. We believe that right now they are discussing containment measures. They are trying to figure out how to stop silver from opening at $85 tonight. Because if it does, the insolvency spreads from the client to the bank itself. We are staring at a contagion event, and silver is the virus. Let's look at the clearinghouse risk in more detail. The CME group, which runs the COMEX, has a default fund. This is a pool of money contributed by all the member banks. It is the insurance policy. If one member fails, the fund covers the loss. But the fund is not infinite. With silver trading at $79, the notional value of the short positions is in the billions. If the price gaps up again, the losses could exceed the size of the default fund. This is the nightmare scenario. If the default fund drains, the exchange itself is at risk. Traders stop trusting the exchange. They stop trading. Liquidity vanishes. To prevent this, the exchange has emergency powers. They can halt trading. They can raise margins to 100%. They can force liquidation only orders. This weekend, the lawyers are reading the fine print. They are looking for the clause that allows them to turn off the buy button. They did it with nickel. They did it with GameStop. Do not think they won't do it with silver. They will do whatever it takes to save the structure of the market, even if it means destroying the reputation of the market. Now, let's look at the collateral crisis. Banks use government bonds as collateral for their trades. But right now, the bond market is also wobbling. The debt ceiling fight is looming. Inflation is rising. The value of the collateral is falling at the exact same time the liability is rising. This is a double squeeze. The banks are getting squeezed on their shorts, and they are getting squeezed on their collateral. This forces them to sell other assets to raise cash. We might see stocks drop on Monday. We might see crypto drop, not because those assets are bad, but because the banks need to sell something to pay for their silver losses. This is how a silver squeeze becomes a macro event. It sucks liquidity out of the rest of the world to fill the black hole in the precious metals market. The meeting this weekend isn't just about silver. It is about preventing a liquidity crisis in the broader financial system. They are trying to ring-fence the explosion. But here is the problem for them. They can control the paper market. They can change the rules on the COMEX. But they cannot control the physical market. They cannot control Shanghai. They cannot control the premiums at the coin shop. If they shut down the paper market, or if they cap the price artificially, the physical market will just decouple. The price in Shanghai will go to $100. The price in New York will stay at $79, and every single ounce of silver in the West will flow east to capture the arbitrage. So their solution creates a bigger problem. It drains the vaults faster. They are trapped. Let's talk about the psychological warfare we are about to see. When these meetings happen, they usually leak a narrative to the press. Expect to see headlines on Sunday afternoon. Regulators monitor commodity volatility. Banks assuring liquidity is sufficient. Experts warn of silver bubble. They will try to talk the market down. They want to scare the retail investors into selling on the open. They need you to sell so they can buy. They need your liquidity to cover their mistakes. But this time, the narrative might not work. The public isn't listening to the banks anymore. They are looking at the price. They see $79. They see gold at $4,500. They see the truth. The confidence game is failing. And when confidence fails, meetings don't fix it. Only price fixes it. So, as we wait for the Sunday open, you need to understand that the game is rigged. But it is rigged in a way that is currently backfiring. The leverage they used to suppress the price is now the leverage that is driving it higher. The rules they wrote to protect themselves are now trapping them. We are watching a system failure in slow motion, and the result of that failure is price discovery. The market is trying to find the price where the banks stop bleeding. And that price is much higher than $79. The emergency meeting is the signal. It tells us we have reached the pain point. Now we see how they react. Will they fight or will they fold? Let's dig deeper into the specific tools they might use on Monday morning. What does a rule change actually look like, and how does it affect your portfolio? One of the most common tactics during a squeeze is the margin hike. We saw them try this last week. They raised margins by 50%. It didn't work, but they can go further. They can raise margins to 100%. This means you cannot borrow money to buy silver. You have to pay cash. This kills the speculators. If you are a hedge fund using leverage and suddenly you have to put up full cash, you have to sell. You can't afford the position. This creates forced selling pressure. In 1980, this is what killed the Hunt brothers. They raised margins so high the Hunts went bankrupt. But there is a difference today. The buyers today are not just speculators. Samsung is not buying on margin. The People's Bank of China is not buying on margin. They are cash buyers. So a margin hike might hurt the small trader, but it won't stop the industrial whale. The whale has the cash. In fact, the whale likes margin hikes because it shakes out the weak hands and lets them buy cheaper. The next tool is position limits. The exchange can say, no entity can own more than 3,000 contracts. If you own 5,000, you have to sell 2,000 by Monday noon. This is direct intervention. It forces whales to shrink. But again, the market has evolved. If the COMEX limits positions, the whales just moved to the OTC market. They moved to London. They moved to Shanghai. Capital is fluid. It flows around obstacles. You cannot stop a global rush for metal by putting a speed bump in New York. The final nuclear option is liquidation only. This is where the exchange says you can sell contracts, but you cannot buy new ones. They turn off the buy button. This guarantees the price goes down because there is no demand allowed on the platform. If they do this, it is the end of the COMEX. It destroys the reputation of the U.S. futures market forever. Investors will leave and never come back. They will move to an exchange that allows them to buy. Shanghai is open for business. Dubai is open for business. If New York closes the door, they just hand the keys to the global market to China. The geopolitical cost of liquidity only is too high. They might threaten it, but pulling the trigger is suicide for the dollar system. So the banks are in a box. They have tools, but every tool has a cost. Every intervention accelerates the exodus from the dollar. Every rule change proves the system is broken. They are trying to put out a fire with dynamite. This weekend meeting is an attempt to coordinate a soft landing. They want to let the price rise, but slowly. They want to manage the ascent so it doesn't bankrupt them all at once. But markets are not manageable when they go vertical. The psychology of the crowd has taken over. The crowd smells blood. Now, let's consider the Monday morning gap. Because of these meetings, because of the uncertainty, liquidity on Sunday night will be non-existent. No trader wants to take a position before they know what the new rules are. This means the order book will be empty. If a buyer comes in, the price will teleport again. We could see silver open at $85, just because the banks are scared to sell. Fear works both ways. The banks are scared to be short. The traders are scared to be short. The path of least resistance is up simply because nobody wants to stand in front of the train. This fear gap is what we need to watch for. If we open significantly higher, it means the meeting failed. It means they couldn't find a solution. It means the panic is uncontrolled. On the other hand, if we gap down, if silver opens at $75, it means they found a way to hit the market. Maybe a coordinated central bank sale. maybe a rule change. If this happens, do not panic. It is an opportunity. It is the system giving you one last chance to buy physical metal at a suppressed price before the physical reality overwhelms the paper game. You have to learn to read the language of the gap. Up means failure of control. Down means temporary intervention. Both roads lead to higher prices eventually, but the path is different. We also need to talk about the physical dealers. They are watching these meetings too. They know that if the rules change, their hedges might be worthless. So they are keeping the premiums high. They are protecting their inventory. Do not expect the dealer freeze to end on Monday. In fact, if the volatility continues, we might see more dealers shut down. The separation between spot and physical will widen. We might see spot at $80 and physical at $110. That spread is the risk premium of the broken system. As an investor, you must focus on the physical price. That is your net worth. The paper price is just a number on a screen used by banks to settle bets. The physical price is what you can get for your metal in the real world. And the real world is bidding higher. So the lights are on, the coffee is brewing, the lawyers are shouting, the weekend meeting is dragging on. They are looking for a way out. But there is no way out. They sold more silver than exists, and now the owners want it back. It is the oldest story in finance, a short squeeze on a finite asset. You cannot print silver, you cannot legislate silver into existence. You have to dig it or buy it. And right now, they can't do either. Monday is coming. The judgment is coming. Hold the line. We need to look at the contagion effect. This weekend meeting isn't just about silver contracts. It is about the plumbing of the entire financial system. Because silver does not exist in a vacuum. It is tied to the repo market. The repo market is the pawnshop of Wall Street. Banks lend cash to each other overnight using collateral like treasury bonds. But when a massive volatility event hits a core asset class, like a 10% jump in silver, it shocks the risk models that govern the repo market. If a bank is bleeding cash to cover a silver margin call, they stop lending in the repo market. They hoard cash. This causes interest rates to spike overnight. It causes a liquidity freeze. We saw this in September of 2019. The repo market broke. The Fed had to print billions instantly. We are seeing signs that the silver spike is causing a similar seizure in the plumbing. Banks are looking at each other with suspicion. Are you the one short silver? Are you the one who is insolvent? When trust evaporates, credit evaporates. And when credit evaporates, the stock market crashes. This is why the Federal Reserve is involved in these weekend meetings. They don't care about the price of silver. They care about the stability of JP Morgan. If JP Morgan cannot get liquidity because their balance sheet is impaired, the Fed has to step in. This is the Fed put. But here's the irony. If the Fed steps in to save the banks, they have to print money. If they print money, silver goes higher. They are trapped in a doom loop. To save the system from high silver prices, they have to do the exact thing that causes high silver prices. Now, let's pivot to the miners' revenge. While the bankers are sweating in New York, the mining CEOs are popping champagne. For 10 years, the miners have been abused by the paper market. They dug the rock, and the bankers set the price. They operated on razor-thin margins while the banks made billions trading paper. But today, the power dynamic has flipped. The miners have the one thing the banks desperately need: physical inventory. And they are not selling. We are hearing reports of strategic withholding. Mining companies are choosing to stockpile their production at the mine site rather than ship it to the refiner at the current price. Why would they do this? Because they know the squeeze is on. Why sell at $79 today when you can sell at $100 next week? They are acting like a central bank. They are managing their reserves. This creates a supply air gap. The banks are counting on new mine supply to flow into the COMEX to relieve the pressure. But the supply isn't arriving. It is sitting in a vault in Mexico. This forces the banks to bid even higher. They have to bribe the miners to release the metal, and the miners are demanding a king's ransom. We also have to look at the nationalization risk again. It is Sunday. Governments in Latin America are watching this price action. Mexico produces 25% of the world's silver. If silver hits $100, do you think the Mexican government will let foreign companies keep all the profit? No. They will implement windfall taxes, or they will demand that a percentage of the silver stays in the country for strategic reserves. If Mexico announces an export restriction on Monday morning, the price of silver doubles instantly. The banks know this risk. That is why they are panicking this weekend. They are exposed to geopolitical events they cannot control. They are short a strategic asset that is located in foreign jurisdictions. It is the ultimate unhedgeable risk. Let's talk about the shadow bank failure rumors. In every crisis, there's a casualty that nobody saw coming. In 2008, it was Lehman Brothers. In this crisis, it is likely a shadow bank or a massive commodity trading advisor. These are unregulated financial entities that use massive leverage. They don't have the same safety nets as the big banks. Rumors are swirling that a major commodity fund based in London has blown up. They were short silver and long bonds. Both trades went against them. If this fund is liquidated on Monday, it triggers a massive market order to buy silver. This is forced buying. It doesn't care about technical resistance. It doesn't care about overbought signals. It just buys until the position is closed. This is the fuel for the melt-up. We are not just looking at organic demand, we are looking at the mechanics of liquidation. A liquidation event creates a price vacuum. It sucks the price higher faster than any fundamental news ever could. And because it is happening during the holidays, the vacuum is stronger. Now, let's look at the tech sector involvement. We talked about Samsung and Microsoft in our previous deep dive. Do you think they are sleeping this weekend? No. Their procurement teams are working overtime. They are trying to secure off-market deals. They are calling the miners directly. We will buy your entire 2026 production. Name your price. If a miner signs a deal with Microsoft, that silver never reaches the public market. It disappears. This shrinks the float even further. The visible inventory on the COMEX is shrinking because the invisible inventory is growing in corporate stockpiles. This is the privatization of supply. The market is bifurcating. There's the public price, which is volatile and broken, and there's the private price, which is much, much higher. The banks are stuck in the public market, trying to cover shorts in a pool that is being drained by the private market. Let's discuss the Monday morning gap strategy. If you are holding cash, you are nervous. You want to get in, but you don't want to buy the top. You are hoping for a pullback. But in a liquidity crisis, pullbacks are shallow and violent. If silver gaps to $85 on Monday, do not chase it immediately. Wait for the first hour flush. Usually, after a massive gap up, profit takers step in during the first hour of trading. The price dips, it tests the breakout level. That is your entry, but be warned. In a runaway market, sometimes the dip never comes. Sometimes the price just goes limit up and stays there. If that happens, you have missed the boat. This is why getting off zero is so important. You need a core position that you never trade, a position that insures you against the melt-up. Now, let's look at the gold correlation. Gold is trading at $4,534. It is stable. It is strong. It is acting as the anchor. As long as gold holds these levels, silver cannot crash. Because if silver crashed to $50, the gold to silver ratio would blow out to 90. Arbitrage bots would instantly sell gold and buy silver to close the spread. So, gold provides a mathematical floor under the silver price. The banks cannot smash silver without smashing gold. And smashing gold is much harder because central banks are buying it. You cannot bully a central bank. So the banks are fighting a war on two fronts, and they are losing both. Let's talk about the media blackout again. Why isn't this on the front page of the Wall Street Journal? Because they don't want to cause a panic. If the public realizes that the banks are insolvent, if they realize the currency is breaking, we get a bank run. We get a run on the grocery stores. We get hyperinflation psychology. So the media ignores it. They talk about tech earnings or political scandals. They are trying to distract the herd, but the herd is waking up. Google Trends doesn't lie. The search volume for silver price is vertical. The people are bypassing the media gatekeepers and going straight to the source. This grassroots awakening is powerful. It means the next wave of buying will be physical. It won't be paper contracts. It will be coins and bars. And that is the one thing the banks cannot print. They can print a futures contract. They cannot print a silver eagle. So, as we wait for the Sunday open, the tension is maximum. The meetings are ongoing. They are looking for a bailout. They are looking for a rule change. But they are running out of time. The sun is rising in Asia. The markets are about to open. And the verdict is coming. In the next section, we will look at the technical targets. If we break $80, where do we go? Is it 90? Is it 100? We will look at the Fibonacci extensions and the blue sky projections, and we will discuss the psychology of holding. How do you sit tight when your net worth is swinging by 20% a day? Stay tuned. The chart is about to be painted. Let's look at the technical roadmap. When an asset breaks its all-time highs, it enters a zone called blue sky. This is a technical term. It means there's no historical data to guide us. There are no resistance lines from 10 years ago. There are no bag holders waiting to sell. There is only open space. In blue sky, traditional analysis fails. You cannot look left on the chart to see where the price might stop. So how do the algorithms know where to sell? They use Fibonacci extensions. These are mathematical ratios derived from nature. They predict human behavior in the absence of other data. We are currently sitting at $79.25. If we measure the move from the breakout at $50, the first major Fibonacci extension target is the 1.272. That target sits roughly at $85. This is the first magnetic level. When the market opens on Sunday night, the algorithms will be programmed to chase the price to $85. It acts like a tractor beam. If we break $85, the next target is the golden ratio, the 1.618 extension. That target sits near $96. And just above that is the psychological fortress of $100. So the roadmap for the next leg is clear. 85, 96, 100. These are not random guesses. These are the mathematical waypoints that the high-frequency trading bots use to navigate the unknown. They will buy until they hit these levels, then they will pause, then they will reload. But there's a human element to blue sky as well. Euphoria. When a price makes a new all-time high every single day, it creates a feedback loop of attention. The media cannot ignore it. The public cannot ignore it. It creates a viral chart. People share it on social media. They talk about it at work. Did you see silver? This viral energy is what powers the move through the Fibonacci levels. It provides the fresh capital needed to sustain the vertical ascent. We are watching the transition from a technical breakout to a social breakout. And social breakouts are messy, violent, and incredibly profitable. Now, let's talk about the retail stampede. We touched on this, but we need to understand the scale of the sleeping giant. The retail public has trillions of dollars in savings accounts, earning negative real rates. They have trillions in checking accounts. Historically, the public is the last to enter a bull market. But when they enter, they bring a tsunami of cash that dwarfs the professional money. Right now, the public is waking up, but they face a problem: accessibility. In 1980, you could walk into a coin shop and buy a bag of silver. In 2025, the coin shops are empty. The online dealers are crashed or sold out. The ETFs are trading at premiums. So where does the retail money go? It flows into the mining stocks. This is the path of least resistance for the average investor. They open their brokerage app. They search for silver. They buy the first mining stock they see. This is why we expect the mining sector to go parabolic next week. It is the only place where retail capital can fit. If you own mining stocks, get ready. You're about to be flooded with liquidity from millions of retail investors who are desperate for exposure and cannot buy physical metal. The penny stocks will become dollar stocks. The dollar stocks will become $10 stocks. It is the trickle down of the squeeze. The shortage in the metal forces money into the equities. Let's discuss the psychological barrier of $100. 3 digits. It sounds impossible to people who remember $5 silver, but in a hyperinflationary environment or a currency crisis, zeros get added quickly. Look at Bitcoin. It went from $100 to $1,000 in a month. When the paradigm shifts, the denomination changes. $100 is the level where the unit bias changes. People stop buying ounces and start buying grams. Dealers will start pricing silver in grams to make it look cheaper. Buy a gram of silver for $3. It sounds better than buy an ounce for $100. This marketing shift brings in the smallest investors, the people with $50 to spare. It democratizes the squeeze, and millions of small buyers are harder to stop than one big buyer. You cannot margin call a million people who paid cash for a gram. We also need to look at the industrial substitution argument again. The banks are hoping that at $80, industry will stop buying. They are hoping for demand destruction. But we know this is false. We know that for a missile guidance system, the price of silver is irrelevant. We know that for a solar panel, it is a small fraction of the cost. But there is a flip side. Panic inventory building. If a CEO sees silver going to $100, he doesn't stop buying. He buys more than he needs. He buys 2 years of inventory today to lock in the price. He thinks, if I buy at $79, I'm a genius when it hits $150. So higher prices actually increase industrial demand in the short term. It triggers a hoarding reflex in the corporate suite. This removes even more metal from the market. It accelerates the shortage. The banks are betting on economics 101. But we are living in behavioral economics. The banks are using the wrong textbook. Now, let's go back to the emergency meeting. What is the nuclear option for the regulators? If they cannot stop the price, and if the clearinghouse is failing, they might try to demonetize silver. They might pass laws saying that silver cannot be used as collateral. They might increase taxes on silver profits to 80%. They might ban the ownership of bullion for private citizens. These are the endgame risks. We are not there yet, but you must be aware of them. When a government loses control of its currency, it attacks the alternatives. Silver is the alternative. This is why privacy is so important. If they ban it or tax it to death, you want your silver to be invisible. You want it off the books. The black market premium we discussed earlier is the price of that invisibility. If the government attacks silver, the black market price doubles. So government intervention is actually bullish for the physical holder, even if it is scary. Let's look at the currency swap lines. The Federal Reserve has swap lines with other central banks. They use these to flood the world with dollars to keep the system liquid. This weekend, those swap lines are likely burning hot. The Fed is sending dollars to Europe and Japan to help them cover their banks' losses on commodities. This creates a flood of new dollars in the system. Global liquidity is rising. And what floats on a sea of liquidity? Hard assets. So the very mechanism they use to save the banks ensures that silver goes higher. They are trapping themselves. They are sacrificing the value of the currency to save the structure of the market. This is the definition of a crack-up boom. The market goes up because the currency is dying. Let's focus on the Monday morning open. We talked about the gap, but what about the volume profile? Usually, early Asian trading is thin, but this time, I expect massive volume right from the bell. Why? Because the ARBs are waiting. They see the Shanghai price. They see the New York price. They are ready to pounce. If we see massive volume on the open, it confirms the move is real. If we see low volume and a price spike, it might be a trap. Low volume spikes can be reversed easily. High volume spikes are concrete. So watch the volume bars. If millions of ounces trade in the first hour, the banks are capitulating. If it is quiet, they might be planning a sneak attack later in the day. We also need to watch oil. Oil is the master commodity. If oil spikes on Monday due to geopolitical tensions, it drags silver with it. Higher oil means higher mining costs. It means higher inflation expectations. Silver and oil are kissing cousins. They often move together during crises. If we see oil break $80 or $90, silver will break $80 instantly. And finally, the bond yields. If the 10-year Treasury yield spikes, it means the bond market is crashing. Usually higher yields hurt silver, but in a debt crisis, higher yields help silver, because it means the government is losing control. If yields spike and silver rises together, that is the signal of a sovereign debt crisis. It means the market is rejecting the government's paper. We saw this in the 1970s. We are seeing it again now. So, the checklist for Sunday night is watch the gap. Does it open above $80? Watch the volume. Is it heavy or light? Watch gold. Is it holding $4,500? Watch oil. Is it rising? Watch yields. Are they spiking? If all 5 lights turn green, there is no ceiling. We go to $85, then $90. The emergency meeting will have failed, and the free market will have won. In the final section, we will wrap up this investigation. We will give you the Monday morning action plan. What exactly should you do when the market opens? Should you buy? Should you sell? Should you hedge? I will give you the specific steps to protect your wealth in a limit-up market. And I will leave you with the final thought on why this weekend changed everything. The world before this weekend and the world after are 2 different places. The paper age is ending. The asset age is beginning. Stay tuned. The conclusion is coming. We have arrived at the moment of decision. We have spent the last hour dissecting the emergency meetings, the clearinghouse failures, and the industrial panic that is consuming the silver market. We have looked at the charts. We have looked at the geopolitics. We have looked at the math. Now we have to look at your portfolio. In less than 24 hours, the markets will reopen. The algorithms will turn back on. The capital will start flowing. And you will be faced with the most volatile trading session of your life. The decisions you make, or fail to make in the first hour of trading, could determine your financial future for the next decade. In this final chapter, part 4, I'm going to give you the Monday morning action plan. I'm going to tell you exactly how to navigate a limit-up market. I'm going to give you the contingency plan for the worst case scenario, an exchange shutdown, and I'm going to leave you with the final psychological armor you need to hold your position when the rest of the world is losing its mind. The meeting is over. The bankers have made their choice. Now you have to make yours. Let's finish this. The first rule of the Monday Open is simple. Do not sell. I know this sounds obvious to the long-term stacker, but when you see the price gap up, when you see your account balance jump by 10 or 20% in a minute, the temptation to ring the cash register will be overwhelming. You will think, I should sell now and buy back on the dip. This is the trap. In a liquidation event, which is what we are witnessing, there may not be a dip. If the banks are forced to cover, they will buy every single contract offered. If you sell your position at $82, you might never get it back. You might watch the price go to 85, 90, 100, and you will be sitting in cash praying for a crash that never comes. You are trading a scarce asset for an abundant asset. In a crisis, you want to hold the scarcity. Unless you have a desperate need for immediate cash to pay a bill, do not sell. Let the market run. Let the shorts suffer. Let the price discover its true level. Your patience is your profit. Step 2 is about risk management. If you hold physical silver in your own possession, you can skip this step. You are safe. But if you hold silver in a vaulting service, an ETF, or brokerage account, you need to audit your counterparty immediately. Read the terms of service. Look for the force majeure clause. Look for the cash settlement clause. If the exchange halts trading, does your custodian have the right to liquidate your position at the last traded price? If the answer is yes, you are at risk. This weekend, you should be considering moving your assets out of the banking system and into private, non-bank storage. If you own an ETF, consider selling it and buying physical metal or buying mining stocks. Mining stocks have equity risk, but they do not have the same delivery risk as a paper silver contract. You own a share of a company that owns a hole in the ground. The hole in the ground cannot declare force majeure. The silver is there. We are moving into a phase where possession is 9/10 of the law. If you can't touch it, you might not own it when the music stops. We have to talk about the nuclear scenario. What if the losses are so big that the COMEX simply stays closed on Monday? Or what if they open, hit limit up, and then announce an indefinite suspension of trading to maintain orderly markets? This happened with nickel. It happened with the Hunt brothers. It is a real possibility. If the exchange closes, the spot price freezes. It might stay stuck at $79.25 for a week, but the street price will detach. In a frozen market, the black market takes over. Dealers will start trading based on the Shanghai price or based on pure supply and demand. You might see spot at 79, but Eagle's trading at 120. If this happens, do not panic. A closed exchange is the ultimate validation of your thesis. It means the paper manipulation has failed completely. It means the price is about to re-rate massively higher once the market reopens. Do not sell your physical metal for the frozen spot price. Ignore the screen. Wait for the dust to settle. The real value of your silver is not determined by a broken computer in New York. It is determined by the physics of scarcity. Now, let's look at the opportunity. If you missed the move in the metal, or if you want to add to your position, where do you go? You go to the miners. We talked about this before, but the setup for Monday is specific. If the metal gaps up, the mining stocks will open much higher, but they will likely be high beta. If silver is up 10%, the miners might be up 20%. However, there is a specific sector of miners to watch: the developers. These are companies that have found silver but haven't built the mine yet. In a bear market, these stocks get crushed because nobody wants to fund a mine. In a bull market, especially a shortage squeeze, these stocks become takeover targets. Major mining companies are running out of reserves. They have cash from the high silver price. They need to buy ounces in the ground to survive. So they will start buying the developers. We are about to see a wave of mergers and acquisitions. When a small miner gets bought out, the premium is usually 40 or 50% overnight. This is the lottery ticket phase of the bull market. If you have a risk appetite, look at the high-grade developers in safe jurisdictions. They are the next domino to fall. I want to give you a mental tool to handle the volatility. Stop pricing your silver in dollars. The dollar is moving down. Silver is moving up. The chart is measuring the collision of two moving objects. Instead, price your silver in assets. How many ounces of silver does it take to buy a median home? In 1980, it was roughly 800 ounces. Today, at $79, it takes roughly 5,000 ounces. We are not there yet. We have a long way to go to reach 1980 purchasing power. How many ounces of silver does it take to buy the Dow Jones? We discussed this. We need the ratio to collapse. By focusing on real purchasing power, you detach your emotions from the dollar figure. You realize that $79 is just a mile marker on the highway. It isn't the destination. The destination is financial freedom. And financial freedom costs more than $79. Be prepared for the narrative to turn nasty. As the price rises, the politicians will get involved. They will call silver investors hoarders, speculators, economic terrorists. They will say that we are holding the green transition hostage. They will try to shame you into selling. This is propaganda. You are not a terrorist. You are a prudent saver. You recognize the inflation before they admitted it. You recognize the shortage before they fixed it. You are being rewarded for your foresight. Do not let them guilt you out of your position. The government created this mess by printing money and regulating mines out of existence. Now the market is fixing the mess by raising the price. You are simply the beneficiary of the correction. Stand your ground. So here's your checklist for the open. 1. Check the Shanghai price. Is it leading? 2. Check the Globex open. Is it a gap up? 3. Check the news. Are there reports of bank failures? 4. Check the dealers. Are they selling? If the answer to all of these is yes, then we are in a vertical acceleration. The best strategy is inactivity. Sit on your hands. Let the market run. Do not try to scalp a few dollars. You risk losing your seat on the rocket. If the market gaps down, the rug pull scenario, check the volume. If the volume is light, it is a trap. Buy the dip. If the volume is heavy and news breaks that the Fed is intervening, then we reassess. But right now, the probability of a crash is low. The probability of a melt-up is high. We are living through history. Generations from now, financial historians will study the silver squeeze of 2025. They will write books about the weekend the banks failed. They will analyze the charts we are looking at right now. You are not just watching it. You are participating in it. You are part of the smart money that saw the cracks in the dam before it broke. This is a rare privilege. Most people live their whole lives without ever being on the right side of a massive wealth transfer. You are here. You are ready. Do not squander this opportunity by being impatient. Do not squander it by being fearful. The math is inevitable. The debt is unpayable. The silver is unobtainable. The price has to rise. And it is rising fast. So here's the verdict. The emergency meeting was a sign of weakness, not strength. The banks are panicked because they are powerless. The physical market has wrestled the steering wheel away from the paper market. Monday morning will be chaotic. It will be loud. It will be scary. But for the silver holder, it will be profitable. $79.25 is the floor of the new paradigm. $80 is the door, and $100 is the target. Get some rest, check your security, and prepare for the open. The greatest show on earth is about to begin. Subscribe.